Historically, all the critiques of fiscal policy and the limitations of its implementation led from a transition to monetary policy being the dominant mode in macroeconomics. Originally, Keynesians argued that the money supply did not matter very much. During the 40s and 50s and 60s, it was common to argue that monetary policy was like a string. It could pull back inflation. You can pull on a string and pull things back. But you cannot push things forward with a string. You cannot push output forward via aggregate demand with monetary policy. This push-pull rationale for the original Keynesian ideas was similar to their rationale for favoring government spending over tax breaks. People might sit on their cash with a push. The pull of cash will definitely take cash out of the macroeconomy, though. With taxes, people might sit on their money, right? If you decrease taxes, if you do a tax cut, people might just sit on their money. So instead, what original Keynesian fiscal policy advocates liked was to increase government spending because it definitely gets spent. However, we started to see these problems with fiscal policy, and in comes Milton Friedman to deliver some critiques along with one more important insight: the importance of fiscal policy and the impotence of monetary policy didn't fit the historical data. Along with Anna Schwartz, Friedman goes into an in-depth analysis called A Monetary History of the United States. Their work began in 1948 but wasn't published until 1963. This is a massive work that they went through and one of the most famous pieces in monetary economic history. Schwartz and Friedman provide important empirical evidence that helped turn the tide in the relative merits of fiscal and monetary policies approaches. Fiscal policy became less important and monetary policy ascended with their study. In particular, Friedman and Schwartz didn't buy into the Keynesian story of the Great Depression. Part of their story has a section on the Great Depression, later published as a separate paperback entitled The Great Contraction. The key factor explaining the depth of the Depression, according to Friedman and Schwartz, was the sharp decline in the quantity of money between 1930 and 1933. It was essentially mismanagement of the money supply once a recession hit. The mismanagement made things worse and caused the recession to turn into the Great Depression. Between late 1929 and early 1933, the M2 measure of the money supply, which was Friedman's preferred measure, had dropped by a third. This is a massive drop in the money supply. This is no small amount. When it's dropped by an entire third, that is going to have a huge impact on the money supply, and it's going to have a huge impact on the economy. During this time period, prices did not fall as rapidly, and thus, according to Friedman, the monetary policy had a negative influence. This was just holding back, and this wasn't just holding back inflation, it was contracting the economy. So they were doing restrictive monetary policy and contracting the economy, causing the recession to be a depression, causing it to be much worse. Changes in the behavior of the money stock have been closely associated with changes in economic activity, according to Friedman and Schwartz. Changes in economic activity, money income, prices, those are all tied to changes in the money stock. They also see this interrelation between monetary and economic changes as being highly stable. Monetary changes have often had an independent origin as well. So this is kind of the third part of their argument. They have not been simply a reflection of changes in the economic activity. So what happens with Friedman and Schwartz's ideas is they're saying, listen, the money stock is closely associated with economic activity. And the relation between money and economic changes has been highly stable, and these changes in the money stock have been of this independent origin. They haven't been because economic activity causes the changes in the money stock. So basically what they're saying is the money stock has been manipulated in some way to cause these economic changes, and this relationship is quite stable. So Friedman took Keynesian economics to task for ignoring the theory and historical evidence that linked inflation to overheating growth and money shrinking to a depression. And so we get this transition from fiscal to monetary policy. Friedman also empirically questioned the view that fiscal policy was important for variations of the economy's output. But overall, he accepted or worked within the aggregated framework and the spirit of Keynesian economics. Thus, many Keynesians really kind of made this transition from fiscal to monetary policy. The empirical reality that Friedman put forth just really questioned fiscal policy's ideas and really made monetary policy make more sense. And so we get this shift from fiscal to monetary policy.